Tony, the data we got today, retail sales, UMISH, what does that mean for the Fed? 50 bips, 75, 100 bips?
Well, you're seeing commentary that's all over the place. In the end, if you're long-term oriented, you really shouldn't care. What you care about is the Fed's verve and determination toward extricating markets from this dilemma on inflation. And clearly it has the determination and all of the abilities to get rid of the problem. It's more likely to be in the 75 realm, but it could easily move to 100 because the Federal Reserve has made clear it wants to get to what it thinks is neutral quickly, and that neutral rate is a point away, so it's possible. But as some Fed members are saying, other things could happen along the way that they're unknown, and so perhaps they want to be a little more ginger. One final word, though, is 55 days between this meeting, the end of this, the meeting coming up, and the next one. Yep. That's longer than we've seen recently when it was around 42. So given that there's added time in between, who knows, maybe the Fed will decide, let's do a little bit more now in case inflation data stay bad. Who knows?
Tony, I'm hearing a number of Fed officials over the last few days downplaying the risk of a recession. Bullard's been on the tape over the last few minutes. I take the yield curve inversion seriously as a signal, but I think it's different this time on the yield curve. If inflation was at 2%, the inversion may signal a recession, but we're not at 2%. We had Waller yesterday saying, we got unemployment so low it can't be a recession. What do you think of those comments? The Fed clearly doesn't see the economic clouds forming and getting worse, certainly over the near term. Do you think they should be more worried, or do you think they're right to be as worried as they are, i.e. keeping an eye on them, but not that concerned?
Well, in this recession obsession at the Fed, in the financial markets, et cetera, the commentary is everywhere. What seems to get lost is what type of recession would it be? And I think in some of the commentary, you're starting to see this idea that perhaps it won't be so bad. And so this idea of a hurricane, for example, is probably the wrong idea. Probably the right idea is light rain, steady perhaps, because the fiscal and monetary authorities won't be able to do much when there is a recession because they've kind of run out of ammunition. The Federal Reserve will want to reinforce the credibility it's established since the Volcker days when Volcker had to reestablish Fed credibility. And when we think about the pillars of the foundation for the economy, the macroeconomic story looks pretty stable. Mm-hmm. Sure, we can reach a recession, but as investors, we have to think about what would it look like and what's on the other side of it. And it's seeming like it's likely to be mild.
So, Tony,
lots of reasons for that.
Tony, where's the biggest misprice in the market? So if we take a look at the equity market, yeah, we're up today, but Deutsche Bank's Jim Reed said that treasuries on the 10-year should be below 2% if you take into account any cross-asset proxies because the S&P has been hit so hard. Copper has been taken out to the woodshed. Where are we mispriced for the scenario you're laying out?
Markets probably are relatively appropriately priced to an extent, but the idea of a sub 2% 10-year would require a much different set of economic conditions, probably a deeper economic recession than market participants might foresee, because the main components of the yield, of course, is three of them. It's the inflation rate, the term premium, and then what the Fed thinks it should have its policy rate at relative to the inflation rate. And with a 2.5% plus type inflation rate ahead of us, as far as we can see, on the term premium likely to rise, meaning the extra yield a bond investor wants for moving out on the yield curve, that likely rises as the Fed steps back. It seems unlikely yields will get back there. And final word on that is the memory of what happened in the bond market this year will last for even a generation. And so investors won't be so quick to drive yields down that fast, but there's likely a period of stability, and we've had it since April.
Can I come back to the light rain, or as we would call it, drizzle?
Oh, no.
Back to the weather. How long does the drizzle last for? That's what I'm curious about. There seems to be this assumption that the Fed raises rates and then cuts them relatively quickly as the recession starts to appear. Yeah. Do you think that's the case? Do you think we could go up and then stay up? Because it's the staying up bit that establishes credibility. Bullard's talking about getting 375 to 4, probably by year end. Do you think that the Fed needs to keep rates higher for longer than the market is currently anticipating?
It's a good point. It's a good point, Guy. In fact, that seems to be a reasonable case. Think about it this way. baby boomers like me, born between 46 and 64, were the only ones that thought inflation could ever accelerate until the recent episode. Now you've got the millennials, X, Y, and Z, all who believe that the inflation rate can go up. And so the Fed has to be really careful about letting inflation expectations get back up again once they get down and you see they're starting to move in the right direction. And the economy has the wherewithal to improve when recession hits. The household balance sheets, you've heard that story about excess saving, $2.5 trillion above the long-term trend line. Household net worth, 150 trillion, 50 trillion more than 5 years ago. Take 10 trillion off that because of the stock market decline recently, but still pretty good. And also the banking system's extremely strong. The Fed in a stress test last month, supposing a 55% drop in stocks, 40% drop in commercial real estate prices, 10% drop in GDP, 10% unemployment, still had banks with capital levels twice the regulatory minimums, meaning money will flow to entrepreneurs, innovators, inventors, and credit-worthy borrowers in a time of stress. So lots of reasons to think we can come out of this pretty good. Lots of investments on the way from the green transition, the supply chains, et cetera, et cetera. And finally, there'll be investments simply to reduce costs in technology, most likely the rest of this decade.
Hey, Tony, next week is going to be a key week over in Europe. Not only are Italian politics blowing up, but you have Nord Stream 1 to maybe come back online on the 21st and the ECB meeting. If the outlook in the U.S. is, as you say, a storm, but not a hurricane, what happens to the ECB? How much can the ECB actually hike?
Well, the European Central Bank has a single mandate to fight inflation, whereas, of course, the Federal Reserve has a dual mandate to fight inflation, but to balance it against wanting a low unemployment rate that, of course, is both that reflects inclusion as well. And so the ECB will have to react to inflation data, and it will react in an odd way relative to history, looking at food and energy prices. This is something we haven't seen before, because when food and energy prices move up on commodities in general, the central banks typically say, let's look through it. Let's look through these so-called supply shocks. But these days, because it's setting into inflation expectations, getting embedded there, they have to move. And so the European Central Bank likely keeps moving until the inflation rate starts to come down, or at least is clear indication that it will come down, and that inflation expectations are stable.